Hello everybody. In this video we're going to take a closer look at the open economy loanable funds model, and we're going to get some insight and also some application. Let's think about our first application, the impacts of higher U.S. interest rates on emerging market real interest rates. And we often think of this as an event that took place last year. We call it the taper tantrum. As a little bit of background, you probably know that since the financial crisis and the recession of 2008 and 2009, interest rates in the United States and in other industrialized countries have been at record lows. Investors have been responding by taking their money, searching for return, higher rates of return, putting their money into emerging markets. We've seen that market participants from industrialized countries have been supplying financing for emerging markets. So this has meant that many emerging market countries, they've kind of, let's say, enjoyed life. They've enjoyed low interest rates, and their highly appreciated currencies have made them feel rich, and this has permitted them to purchase imports far in excess of their exports. So they've been running substantial net export deficits. Now this started to come to an end in May of 2013 when Fed chairperson Ben Bernanke, he was then the Fed chairperson, announced that the days of low interest rates would likely end soon, that the Fed would begin to taper some of its asset purchases, and that as a result, some global interest rates rose immediately. So we can use our open economy loanable funds model to tell us what the implications of this rise in interest rates would be for emerging markets. So I'm looking at the spreadsheet now. You can see that initially we have, under both alternative 1 and the baseline scenario, the same interest rate, and we have over here an equilibrium exchange rate. So now we're going to assume that the external real interest rate rises 100 basis points from 3% to 4%. And you can see what happens. As the real interest rate rises, savings is encouraged, investment is choked off. So we have a new lower savings investment balance, and that's reflected over here in the shift of this gold line from the solid gold line to the dotted gold line. And you can see that along with a lower trade balance or net export deficit, that is to say more exports, less imports, we have a less valuable real exchange rate, a real depreciation. So let's summarize our results. An increase in world interest rates will mean a movement from the baseline to alternative 1. Residents of the small open economy will now save more and invest less. Foreigners are now willing to provide a lower amount of financing than previously. The real exchange rate depreciates and the deficit on net exports decreases. Let's go to application 2. And we're going to learn about here a fiscal expansion and in an economy that's considered to be sound and safe by global investors. The government is increasing its expenditures without correspondingly increasing taxes, or alternatively it's cutting taxes. Either way, public savings is falling. This is going to mean, if we go to our spreadsheet, here we have a situation where we start off with the baseline, and we start off with alternative 1, the same as the baseline. The interest rate is the same, and public savings now declines, and we're going to assume that it declines by this amount. This is going to mean a leftward shift of the green savings line. We're now going to be saving less, but because the interest rate has stayed the same, that means that our investment is going to stay the same, because foreigners have agreed to provide more financing than previously at the same interest rate. So this decrease in the savings investment balance is going to be reflected over here by a leftward shift of the gold line from the solid gold line to the dotted gold line. This is going to mean, of course, a higher net export deficit, lower net exports. It's going to mean more imports, less exports, and it's also going to mean, because more money is coming into the country to finance a higher net export deficit, we're going to have a more appreciated real exchange rate. So let's summarize what we just learned here. A decrease in public saving, what we call a fiscal expansion, shifting the green savings line to the left. This is going to mean that total domestic savings declines while investment remains the same. Why has this happened? Because foreigners have passively agreed to provide even more financing than before at the same interest rate. So investment now exceeds by savings by even more, and the net export deficit is even higher, even more imports and even less exports than before, and the real exchange rate has appreciated. It's now more valuable than before.